Otherwise you got to answer to the man if you don't go on time.
We don't want to answer to the man.
That's right. We do not want to do that. So, how you been, brother?
Well, like I told you in the green room, my friend, I am easing out of COVID. I didn't even recognize it for what it was, man. It started as an intestinal thing, really, really violent. Like I'm in
Mm.
pain, may have to go to
Oh,
the
wow.
ER. And I didn't even think about it. And then it kind of went from that into, a respiratory issue and nose and all that stuff. And
Okay.
finally, it's like, maybe I should take a COVID test.
Yeah.
And then poor Lisa, I gave it to her, and we're both coming out of it, though, man. How you guys doing up there?
Oh, we're good. We're good. And what I really heard out of that is it's all your fault.
Ah, yeah, that's right.
That's what I got out of that. So,
Nothing's changed. Will, come on, man.
no, nothing changes now. We're well trained.
That's right.
Not bright, but trainable. That's us.
It's been my fault since what, December the 5th, 1986, our first date.
Oh, it was before that, brother. It was before that. She'll blame me for the stuff before that. Because had you been in her life before that, you solved the problem. It wouldn't have been a problem. So therefore, it's your fault. You weren't there.
So there's ipso facto, it's my fault.
Mm-hmm. Yeah.
Post hoc ergo propter hoc.
Is that a Latin way of saying it's your fault? Is that what that was?
Correct. Yes.
Okay, gotcha. All right.
Will
I see Will
Rhodes
Rhodes is on, so the Wills outnumber everyone. We can just stop the show right there.
We're well on our way to a quorum. Will, thank you so much for being on out there in Missouri. Hopefully you and your family are safe, my friend. Let's see here. I have not even, fair disclosure, I haven't even looked at today's show. I've been helping my bride with, she's still laying in bed, matter of fact, and hopefully she'll be doing better. But I haven't even looked at it, so I'm very excited. Right. It's going to be just as fresh as it is to everybody watching this morning.
All right. It's just like Christmas morning here at our home, because when everybody else opens their presents from my wife and I'm just as surprised as they are.
Same.
Because she does all the shopping and the wrapping, and I'm like, wow, that's great. You're welcome. Yeah.
She's like, we got this for Remy. Let me see, look. I'm like, yeah. Oh, wow, cool. I didn't know that.
Yeah, that's awesome. Yeah. Didn't know such a thing existed. So
we got, do we have an official quorum?
We do. We do have a quorum of Wills.
Okay, thank God. So my brother Jeff is. I was going over. I hope you're all doing well, Jeff. I hope you are doing well. I haven't seen my brother days since Lisa and I've been down. But we got Alan Kelly on from Triple Occupy, Virginia. We're slowly circling down the toilet.
Let's talk about that for just a second, because I saw and Alan, fill us in if I get this wrong. Correct this. But the way I understood the Virginia State Supreme Court is going to rule on a redistricting in Virginia that's going to take it from like 5 red seats and 5 blue seats to 9-1 or maybe whatever. It's going to an overwhelming blue majority. And the Supreme Court is saying, oh, we're going to rule on that within the next week, very shortly. And the governor just goes ahead and does like a ceremonial signing of this bill, like it's actually a bill, but it's not. It's something like that. Yeah, and she's laughing the entire time. It's like, okay, wow. I mean, the Supreme Court is looking at this right now. I mean, you think that might sway the court? I don't know, man. I haven't followed it that closely, so I could be off. It was on Twitter, so it's real. Okay. But I just, it looks like it's circling the drain out there, brother.
We should probably do like a nighttime bourbon and news with Alan and just bring him on and like catch us up to speed, man, as far as like, awesome. How did this happen? Because I think about my brother's comments, like this should be a lesson for all of us here in the South. That goes for Ted down in Mississippi, Tony down in Georgia, Missouri. I mean, in a lot of ways, when I think about I always think about the Civil War, and I'm like, what is bleeding Kansas? Leading up to the Civil War you had. And is bleeding Kansas, Minnesota? Is bleeding Kansas, Virginia? Is it both?
Yep. And it's and what I do find interesting about the gerrymandering of this is, the media is throwing a fit because Team Red's doing, redistricting, gerrymandering. It depends which side of the aisle you're on, who you're talking about, whether it's, redistricting or gerrymandering. But Team Blue's been doing this for a while, and then Team Red fights back, and Team Blue throws a fit. I'm coming up with an image here right now. I'll throw up. It'll take me a second here. This is the, I say very facetiously, the great state of Illinois.
You're all home state, right?
Actually, Iowa was my home state, but I did most of my, if you want to consider me growing up in Illinois. Um, this has been the Illinois state map forever. Gee, that looks like a non-gerrymandered map, right? And so obviously Chicago area blue. The blue area you see from St. Louis, the St. Louis, Illinois side of St. Louis, up through Springfield. Springfield, I should say, St. Louis, very poor, tends to vote blue. Springfield, obviously, state capital, very blue. The other blue area you see in the Northwest, that's basically your union areas. I grew up in the Quad Cities there, right where the Mississippi River turns east-west there for a bit. That's John Deere territory. Peoria is Caterpillar. Gee, you think maybe they drew those maps way back when for that reason?
Yeah, but you know what? What's funny is some blue collar redneck, God bless his heart, dude that works at Caterpillar just happens to be a union member. He's not a freaking 2026 Democrat.
I agree completely.
And it's like this is ridiculous.
Yep. So,
and do they still vote in lockstep? I don't know.
Yeah, way back, Glenn Beck had a book where he went through some of the more egregious gerrymandered districts, and this was down in the lower level districts, state politics type stuff. And there was one that went down one street to connect two areas to make a district work for one side, and it's like, come on, guys, this is not what the founding fathers envisioned. Nobody would envision this system, right? Either way. So we need to get back to some founding principles here.
Okay. Now I will say I'm going to push back on it just a smidge, and it's coming from a direction that maybe not a lot of people would think. So like when you think about Marine Corps military recruiting, the state of Tennessee, if you go from the eastern highlands of Tennessee all the way to the Mississippi Delta and Memphis, you go from a huge demographic shift, cultural shift, everything. There's nothing about the Mississippi Delta of Memphis, Tennessee that's anything like Johnson City, Tennessee, the northeast corner near Virginia. Zero. So I say that because we do the same kind of thing with recruiting. You know, we gave that piece of Tennessee away to Little Rock, Arkansas. There's a lot of similarities there and down through Mississippi. And then somebody's like, yeah, but we need to bring the state of Tennessee under one banner, recruiting banner. But it's like, it's different. You know, the culture is different. The way we need to train. So I was a assistant recruiter instructor for the state of Tennessee. And it would be easy just to say, I'm going to teach you how to recruit in Tennessee if I can forget Memphis. This is the culture. This is the way people communicate. This is the way. So I think there is something to those areas, perhaps, that are more germane than if you made it a calico area. I don't know.
Okay. Yeah, no, that's a good point.
It's a long-winded answer, but yeah.
You know, and there could be, I'm not saying every district either needs to be like a square block of 100 square miles or, you know, some completely arbitrary thing. That's how you end up with the map we have in the Middle East, which is part of the problem we have in the Middle East, right? So, yeah, there can be some judgment involved there. But, you know, when we look at the Illinois map, it's, you know, there's no cultural issues across there, right?
No.
I mean, other than the fact,
like I said, it has more to do with, you know, where the industry is and unions are and blah, blah, blah.
Yep. Yeah. So, what's Alan say? There's a follow-up.
Alan says they ran on making everything affordable, but they're taxing everything. 11% on guns and ammo, 500 on suppressors. The government has made nothing affordable. You want to make something affordable? Let it float on the market, and the market will find a way.
Well, and to that point, let me see here. I'm going to throw this other Copper Jacket TV on YouTube. One day ago, new bill will end online ammo nationwide. That's everything I know about this right now.
Say that one more time, Will.
Sure. New bill will end online ammo nationwide. And that's Copper Jacket TV is the name of the channel on YouTube. I don't follow them. I have no idea who they are. That's everything I know about it right now. But bills get introduced all the time for weird stuff, and maybe they're just playing it for clicks. I don't know. it's working so far. They got 57,000 views. And it was a day ago. But
buy ammo, it's cheap right now.
Yeah, absolutely. Buy steel case and buy a spare extractor and ejector. Watch a YouTube video on how to change them. I think of the last batch of steel case 9mm I bought. 18 cents a round, 17, somewhere that was cheap.
I've never bought steel case, I don't think, in my life. So
it's somewhere. This is cheaper in the brass, of course.
Yeah,
and the cleanup's easy with a magnet.
Now that is the big one. That is the big one. But where I go to shoot, I don't need to clean it up. And you got what, 75,000 rounds of brass?
Probably something like that. I got many 5-gallon buckets full.
That's impressive.
Yeah. So it's just like, I mean, at some point, it's like, why bother?
I love
extractors extractors and ejectors are cheap. So
they are, man. That's true. Unless you need one in a gunfight, then it's you're holding a hammer in your hand.
That's true, but that's also where I break out for my carry guns and even my competition gun. I only shoot brass through those. I've got a duplicate practice gun, and that one I just terrorize. I try to see how many rounds I can go in between cleaning that one.
Yeah, I tell you, the Glock handgun. I mean, when I'm shooting back in the early 70s, I should say mid 70s, as a kid, we had to clean the guns after every one because you're shooting this old corrosive ammunition. Well, I mean, nowadays it's not the case. It's not going to really do any kind of long-term harm.
Yep.
But back then, man, they would pit out a barrel in no time if you weren't careful.
Yeah, for sure.
Will Parker says, understanding human terrain is a way to crush your enemies. That's a Marine Corps concept, and it's absolutely true. And going back to this gerrymandering thing, that's what the left has been doing for a long time. They've been using this to really take over areas where they shouldn't be able to take over areas. So, and now that the Republicans are late to the party, they're trying to play that game. Everybody's crying foul, and it's like, wait a minute.
Yeah,
I didn't create these rules.
You
see.
Yes,
Amen, well played, Tony. I'm with you, brother.
Well played. But he makes better food for sure. So
no doubt.
Bring that Illinois map back up. I just realized something. So if you look at the part that comes up from St. Louis through Springfield, it's been a long time since I've driven through that part of Illinois, but I bet you that reaches just up to Champaign, Illinois, which happens to be University of Illinois. And the same thing with the one that comes down through Peoria. It actually continues down. I bet it goes basically down I-74 from there. So, yeah, I mean, we're seeing this, and it's so funny. This is just accepted in the deep blue states. I mean, let's not forget, before redistricting, California was a deep red state.
Well, look at what Jeff's saying there. Massachusetts, 40% Republicans with zero representation. Yeah. Ask Andrew Bronco about that. That's why he left. And James, I don't know if he's on yet, but James is up in Massachusetts. He came to our high risk environment course. And by the way, we're getting ready to start marketing this year's Warrior Camp. It'll be in November. I'll stay tuned for dates, but I'm going to try to get it out there to you early enough so you guys can plan on attending this year. More to follow on that one.
Yeah. Well,
Don Bothwell is on, brother.
Good to see you, brother. And Massachusetts is a good example of if we extrapolate that out nationwide, people will say, well, there's, it's a purple country and we have no representation. But on a state level, they go, yeah, don't worry about it. Don't sweat it. Right. So there's no perfect system.
I will tell you, and again, I love how we haven't even touched the slide deck yet. This is people love this. We talked about this in a previous show or two, the way that Rhodesia did their voting with an A roll and a B roll. I mean, I thought it was fantastic. People respond to incentives, and if the incentive is I can sit on my ass and make money, they're going to sit on their ass and make money. I've talked about that, hiring refugees coming into this country and that won, visa lotteries in Africa. Okay, come on in, man. I got a job for you. I'm gonna pay you more, more than twice what you're gonna make as a minimum wage, and they don't last because they figure they can just sit on their ass and make money, and we're gonna let them vote and all this other crap. So people respond to incentives, and maybe we'll do another show on voting around the world. I like that Fetterman broke ranks with the Dems. Did you see that?
I did not. What was the deal there?
He said, I think that people should show an ID to vote.
Good. I mean, we got to show an ID for everything else, right?
No kidding, bro.
Yeah.
Do you have to show it? Do you have to show your pilot's credentials to get a job flying commercial airlines? You don't have to show your ID for that.
They never asked for that. Now that you mention it, they were like, "We'll take your word for it."
Yeah, we'll take.
Oh, you got experience? Yeah, fine, no problem.
That's good enough.
Here's the keys. Take it out for a spin. Yeah. So let's dive in here. So, I had to throw this one in there just for you, brother. Just for you.
You're killing me, man.
All right. So fear, greed's in neutral 45.
Now, in truth, I would say that I will give you trading like a meme stock. That's fine.
Mm-hmm. Yep.
I thought I heard you say is a meme or a meme stock.
Oh, you mean the pet rock? Is that what we're talking about here? Is the pet rock?
Oh, guys, thanks for coming in today. We're going to be going ahead and wishing you guys all the happiness.
Okay, so I was going to save this for a later show, but since I got your heart rate up here,
pet rock.
Okay. Oh. All right, hold on a second. It's going to take me a second. There it is. I found it. I got it. I had AI make this just for you, brother man.
Oh God. Oh. Oh, William.
Oh, yeah, I had to do it for you.
I tell you what, let me buy any pet rocks you have for. Michael says it's absurd that there may be any other legitimate reason to not require ID to vote. Then you are supporting fraud. I couldn't agree with you more.
I believe the fraud is the legitimate reason.
Yes,
good sir.
There is no other reason.
Yep, that's the only reason not to.
Yeah, but now that you've insulted me about my favorite pet rock, I don't know where we go from here.
Oh, fight's coming. Be ready.
Yeah, no shit.
So, and I am going to push back on something that you said last week, and I've said before, and I got thinking about it. And it's the debasement trade: gold, silver, even uranium, platinum. Debasement trade, right?
Explain that for people that don't understand.
Sure. So, the dollar's being debased because the purchasing power of the dollar has been going down, and gold or silver or whichever pet rock you prefer
rises relative to
offsets that, right?
Mm-hmm.
And in short periods of time, we may see some of that, and that will drive some. Okay. But it really got me looking at it. And if you go back to I took it back to 1929. When the US dollar came in 1913, and we know they printed a bunch of the 1920s. That's why we got the roaring 20s. But if you go all the way back to then, we know that from 1913 to today, the purchasing power of the dollar has gone down about 99%. Okay. You can look at different numbers. It's between 96 and 98, according to Google, but this is called 99 because it's an easy number, right? So I'm going to bring my fancy calculator up here. Gold was worth $20 an ounce in 1929, and it was even fixed to that prior to that, before they confiscated it all through FDR's executive order and repriced it to 35, right? So if the value of the dollar has gone down 99%, it would have to go up 99x to get back to parity, right? So if you take 20 times 99, that would mean the fair value of gold in purchasing power with the dollar is basically $2,000, $1,980. But yet we sit at 5,000 this morning. So you can make the argument that it's done better than that, right?
Yep. And there's a reason for that,
right? And there's exterior reasons other than the debasement. Right. Central banks are accumulating it, supply and demand. It's still a commodity, right?
Well, there wasn't technology in 1913. You didn't have a cell phone that had to have gold. You didn't have industry that had to have gold. Right. It was just a monetary metal. Now it's serving dual roles.
It is. I don't know how much it's doing in industry. Silver, yes. I'm not sure how much. I really don't know how much gold is doing in industry. Okay, but you would have to go up 2.5x. to get from the 2,000 to the current 5,000. So, and supply and demand, it's a commodity, right? So it got me looking at it. Even if you price it out at 35, the post executive order, you take that times 99, you're looking at basically 3,500 an ounce. So my point being that the debasement argument works, but if
only we look so far,
only so far. Exactly.
But you have to. I think that 1913 and 2026 are may have the same human beings in it, but the technology is light years away.
I agree.
And gold is in that technology. So I think that is probably what's, I had some speculation onto it, manipulation onto that, but I'd say that technology is mostly responsible for the delta between the two numbers.
Yeah, I would say.
But here's the thing, and this is true. You could look at it like in the Roman times, 1 ounce of gold would buy you a really nice toga if you were a senator. Well, 1 ounce of gold will buy you a really nice suit if you are a senator. One gold coin in Roman times would buy you a big fat cow. 1 gold coin today will buy you a big fat cow. So
okay, I agree.
Yep.
Across the board. But let me throw this out there, and I need to figure out how to do a share screen on StreamYard at some point. But so let's go back. If we go back to the original kind of where I started with this was the debasement trade, and if you take 20 times 99, you end up with about 2,000, right? Well, if you go up through January of 2024, we're still at 2,000 an ounce. So you could make the argument it's been strictly a debasement trade from 1929 to about 2024. Okay. And then it started going crazy, right? Because from January of 2024, it went from basically 2,000 an ounce to 5,000. So it went up 2.5x in that period of time. Well, we didn't debase the currency that much in that period of time.
No, but we started slapping people around with the dollar too. We weaponized the damn currency.
So my point is the debasement argument worked until 2024-ish.
Sure.
And now that has changed. So what my point is I'm thinking about it as an investor. It's like, okay, so if let's say magically tomorrow, we get rid of the Orange Man and we get, somebody more reasonable, President Newsom, let's say, okay, who brings globalization back, takes the world back to normal. NATO is a happy place and we all, do dances over there and, blah, 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 right? We go back to the old way. Does gold go back to 2000 if other central banks sell it off? Now, I'm not saying any of that is plausible or real, but as an investor, I need to challenge my own assumptions about what's going to happen and be if things start to change. 2028 isn't that far away, if that starts rolling in, because the debasement argument worked until 2 years ago. After that, we haven't debased the currency that much that fast. It's been the other stuff you spoke of. And I agree completely with that. But as an investor, I need to steel man that argument. Steel manning in AI is you pit one AI against the other. You ask Gemini a question and you plug that into Grok, and then you take that answer, you plug it into Chat GPT, and you run around in a circle and you make them fight each other. Yeah. So I'm trying to do that in my own mind here is, okay, if something changed, would gold go back down to 2,000 an ounce? I don't think so, because it's hard to go back, right? And but there's also a limit. Other central banks can't buy infinity of gold. So unless something else happens, do we really see gold going to some of these numbers you hear, 15, 20,000 an ounce? How much room is left in this run based on the central bank argument, which I believe is valid? And that's what I've been trying to game out in my mind.
There's a couple different things for this. One, I've heard it said, and somebody can fact check this, that it costs about $1,300 to pull an ounce of gold out of the ground. That's your basic mining cost. So if there's a floor under gold, it's somewhere in the neighborhood of $2,000 to $1,300 per ounce. It ain't going to fall below that, I don't think. The other thing is, I think asking artificial intelligence is just that. It's artificial intelligence. There's something weird about human beings and gold, and there has been from time immemorial. So I think that a clearly rational person might go, I don't understand, why the hell would a central bank be concerned with getting this shiny shit and filling their vaults full of it? But so some of it is somewhat irrational. But to this point though, and it speaks to something Mr. Gentili is saying. It says, "Say it ain't so, Will. Is there a debasement in the full faith and credit of the federal government?" And that speaks to why did we abandon the gold standard? Because ships were on their way to our ports to go, here's the dollars, we'll take the gold and head out of here. So they weren't doing it for, we got gold, we're going to drop it off and you give us all the cash we can put on this boat and fire up the printing press. That's not the case. So I don't know what the right number of, and this is a question for you, what percentage of a portfolio should be comprised of precious metals? And then when you look at your breakdown of precious metals, do you have some thoughts on that? Of course, not financial advice, but do you have any kind of thoughts on that?
Well, since January 2024, having all of it in gold would have been a really good idea. But that's not real sound thinking there, in my opinion. But the standard forever has been 10% precious metals. When I say standard, not even your standard financial planner, I would say your standard thinking person, right? And then within that, it kind of depended on, it kind of depended on age. It's volatility. Silver is more volatile. So if you're younger and you can ride out like the housing crisis, run from 15 to 50 back down to 15 and have not really affect you too much, maybe more silver. Even the likes of JP Morgan are now, instead of advocating a 60-40 portfolio, 60% stocks, 40% bonds, they're advocating a 60-20-20, 60% stocks, 20% bonds, 20% precious metals. So,
and that's about where I am right now. That's kind of where it shakes out.
Yeah. I ran during this run up, I ran considerably higher. At one point I was about 40% precious metals.
But ETFs are legitimate.
ETFs, yeah. It's because I don't have enough liquid cash on hand to do that. And at some point, we were going to see some pullbacks in there. Same way when you and I were talking, I think it ran to what, 4,400.
And you can short an ETF, you can't short physical, right?
Correct. Yeah, it ran to 4,400, and then you were clutching at your chest when I sold a bunch of my ETFs there, but I repurchased at the pullback to about 4,000. And that's a 10% pullback. I would not be shocked in the least to see a pullback here down into that previous high of that 4,400, and that's about an 8% pullback from today's prices. I wouldn't be surprised to see that because there's a lot of people buying the ETFs, which is driving things, and so it is turning right now. The gold and especially the silver market is turning into kind of a stock play. The volatility is going up quite a bit, hence the headline we had here. And they're playing it for the headline with the meme stock thing. But we are seeing that kind of volatility. The point of precious metals forever in a portfolio was something that would just be very stable.
You wouldn't even investment, it's an insurance. You know what I mean? I mean, I had a friend of mine who's like, man, I screwed up. Because I didn't know he had about 100K worth that he had bought, in 2019, whatever, when gold was maybe 1,500 an ounce. And he bought, and when it 2x'd, he sold out, and now it's like, shit, I didn't think it was going to go that high. Like, it may by 2028, it may be $10,000 an ounce.
A lot of that, I think at this point, we've moved largely past, assuming there's not something that happens that causes huge money printing. I think we've moved so far from the debasement side of owning gold that now the news cycle will drive it. If suddenly the world settles down somehow, could we pull? I don't think we'll pull all the way back to 2,000 an ounce where it was before, but I wouldn't be. I mean, if the world magically stabilized, which with the fourth turning, I don't really see happening.
It ain't going to. Between now and 2033, it's going to be more volatility, more volatility. We got a war on the cusp with Iran. They're not backing down. China's eyeing that. I mean, the Ukraine thing has gotten bananas. They've ran out of North Koreans now. They're bringing in sub-Saharan Africans to fight in Ukraine. And did you see where they turned? There was some American fighters over there, got a helmet cam on, and he's trying to get these two sub-Saharan Africans that are kitted out as Russian soldiers, and they're pointing weapons at them. And finally, the two Africans killed the Americans that are over there fighting for them. That helmet cam is hard to freaking watch, man. But that's where they're at. Freaking mess. So
and
that
as an
stability idea is
aside,
bananas, man.
has nothing to do with the topic of conversation, but I saw this last night and I laughed out loud. It was in World War II. The Russians, Soviets, trained excuse me, guys, trained dogs to carry bombs under enemy tanks and then blow up. The problem was they trained them on their side of the line. So when they set the dogs loose, the only tank they recognized as a tank was a Russian tank, and they ran underneath those. They stopped the program.
That's a
but
shame.
Sorry, yeah, it was poor dogs is the only thing I thought. But yeah, so yeah, I mean, so my point of thinking about this isn't, oh, gold's going to zero or gold's going back, and you were right with your 1,300 ounce. Gold's not going to 1,300. But my point is that at some point, these central banks have to stop buying. I mean, the Israeli central bank only has so much of what their currency is to buy this, right? So that at some point, that underlying driver of this run, I'll say post-Ukraine war start, is going to dwindle off because there's only so much they have. Now, the Chinese have a lot of money, and will some of them print their money to buy gold and drive that demand up? Yes. But it's not an infinite thing that will go on like the loaves and the fishes. So I'm not saying that's imminent by any stretch of the imagination, but this is also trying to be a prudent investor. What could drive this, and then start looking for those signs.
Okay. Again, this side of the thing is in gold investment. This side is gold insurance, so it depends on, again, your psychology of which you go into this with. Gold is not an investment to me. It is insurance. So if you're thinking investment, I go with him. If you're thinking of insurance, I will side with myself. And I think that with BRICS getting their own exchange, with SIFs, trying to get away from SWIFT. And, oh, by the way, China sees itself as being the next reserve currency here in the next 50 to 100 years, or maybe even sooner. Who knows? If they take Taiwan, it's definitely going to happen sooner. Then, oh, by the way, you would want to say, oh, look at the renminbi. We are backed by gold. They're backed by Jack and Squat. So I think it's in, why are they buying gold? They just like it. They need it for industry. Bull crap. They want to be the next reserve currency, and they're going to have something to stand on, not just the manufacturing prowess and the energy to make it happen and some janky artificial intelligence that's behind the times. But, oh, by the way, we have this gold stuff that it's backed by. My thoughts.
And I the only pushback I'd give you there is on both.
True. I would say your foot is more heavily weighted toward the investment piece.
My thinking, the amount of time I spend thinking, is more heavily weighted that way. Because the other side, the insurance side, is the physical ounces sitting up in the gun safe. I don't think about those. Yeah. They're not even on the personal financial statement because it's never going anywhere.
Unless we're in the streets pushing our
at which point my personal
financial
wasteland statement doesn't matter, and the computer probably got sold off for a loaf of bread anyway, so I wouldn't even know what it was. But so I guess the amount of time I spend thinking about it is probably 99.8% on the investment side, because those are only worth something if we're on the streets. So therefore I don't think about them.
Yeah.
So yeah. Now, when it takes a 10% pullback here, which I think it's going to, I mean, the chart looks toppy, so assuming something else doesn't drive it. When it took that 10% pullback in mid 2025, I bought more physical as well, because it was just a buying opportunity. So I'll do the same thing here on any major pullback.
Same, absolutely.
Same thing. Not financial advice. Only do this if you are disciplined and so on and so forth. I actually took out I did what they say never to do. I took out a 401k loan to buy physical on that 10% pullback. So I bought it at 4,000. It's at 5,000. It's 20% gain. Now, I could have bought GLD inside the 401k, but I wanted more physical. So it gave me a way to do that. On a 401k loan, guys, you pay the interest back to yourself. So I got that interest back to myself, and I've got the physical sitting upstairs. So, now financial advice is not for everybody. don't do a 401k loan to buy big screen TVs. This is really big. Okay. But car parts are an acceptable reason for a 401k loan. Yes.
Don says, I think that given the highs of gold, that any decent dip will be a buy signal to those who feel left out. There's a lot of FOMO going on out there that'll keep some on again, off again, momentum for a while. True. I would love to see this. I would love to see a chart that shows that when the Federal Reserve has to step in and buy treasuries relative to gold, the price of gold. So my hypothesis would be that fewer people showing up and the Fed going in and buying, does that send the price of gold up? Whether it's correlation or causation, it doesn't matter to me. I would just be interested to see, because every time I think of that, I think of that as a barometer for the faith and credit in the dollar. You know what I mean? Like, nobody's buying the shit. All right, we'll step in and buy it just so we can keep spending.
Sorry, I got my multiple screens running here, and so QE1 started in November of 2008. So bear with me 1 second here while I.
And I'll let y'all look at some pet rock here while Will is doing that.
Okay, so give me a second here. I need the.
Guile is on.
I need to get rid of that.
While you're doing that, Jim is on from Indiana. Thank you so much. Brian is on from North Texas. So glad to have the 18 folks watching us on a beautiful Monday morning. Michael says, what is the current capacity of existing mining operations for gold? Well, now that we've gobbled up Venezuela, who has untapped gold mines down in the south that were being run by illegal enterprises, now that's going to pull under Daddy America. That's going to be a good thing. They talk a lot about the oil, but the gold and some of the other rare earth minerals that are in southern Venezuela is a big boom for us.
Almost there. Oh, come on. Why am I not? There we go.
And if you're bullish on gold, put that in the comments, man. I'd love to hear people that are like, yeah, I'm bullish, or I'm selling it, or I'm investing in it, or ETF only, or physical only. If you got any thoughts, man, from the 17 folks watching us on 2 platforms, let me know what you thinking is.
All right. Well, just about there. Just got to add the file. There you go. The red lines where QE1 started.
So quantitative easing.
November of 2008 that started. So here's...
Was that under TARP, or was that something separate?
That was QE1. TARP was a laughable $700 billion. Yeah.
Eventually they'll take real money.
And just make it rain, baby. All right. So here's... And we talked about this previously, but it's good that we're bringing this all together. So we talked about gold versus the S&P 500 during this period of time. And you remember they swapped out. Gold went up 100%-ish during this. And you can see that there went from 700 to 1700 or thereabouts. And then it was dead money for 8-9 years, whatever the number was. And initially, when everything fell apart during the global financial crisis, S&P went down 40%, whatever it was, while gold went up here post this red line. And it goes back to the discussion we had a while back, where when they start lowering interest rates, like, you can't really start, their leading strategy is not printing money, it's lowering interest rates, right? Because you can't justify printing money until you get interest rates close to zero. And I will note for all of you watching that they started lowering interest rates last year. So that's they're starting to see weakness out there. And then rates come down and down and down. Now, Kevin Warsh coming in June 1st is a little bit of a monkey wrench in there. Okay. Now, that said,
to explain why, for those that aren't following,
he's a sound money. He's more of a sound money guy. He wanted to raise interest rates during the housing crisis. Okay. And
because he understands what a lot of people don't understand.
Well, there's a great interview with him on I'll see if I can bring it up here after we get done with this point. It's about an hour-long interview. If you look up Kevin Warsh, Hoover Institution, about an hour-long interview, and he goes into why he was for that. And I really liked what he said. It would have caused a much greater economic calamity than we had.
But
his reasoning was sound based on what the Fed's jobs are. So it's well worth
price stability, and everybody has a job that can get one.
Exactly. And the job thing got added in the 70s. I didn't realize that until that interview. Carter put that in there so that the joblessness could be pushed onto the Fed off the politicians. Didn't know that until that interview. Spoiler alert. Okay. I didn't know that either. So the point is, when they start printing money, gold takes off. So there's your debasement argument, right? Mm-hmm. And it's valid. But then what happened after that? They started printing less money, and the money they had printed made its way into the stock market. So my argument to this, and this is whether it be the pet rock of your choice or the stock market or the bond market or real estate or any other asset you can come up with, the sun shines on every dog's ass every now and then. Mm-hmm. And everything's going to have its run, and then it's going to have its period where it's dead money. Look at the NASDAQ from 2001 to 2013. It was dead money, right? And then it's taken off. So my outlook as an investor is recognize these bigger trends. And this is one we had talked about previously. When they start cutting interest rates, that means they're seeing something happen in the economy that is generally slowing. That started happening last year. The general bottom for the stock market will be in when they start printing money, because that money will then flow through the economy into the stock market. And a lot of people will take that money and just invest it straight away. By that, I really mean the banks, because that's what happened with a lot of the QE money. It never got lent out in the economy the way it was intended to. They just put it in the stock market. So the point is, we can look at these patterns and do that. Now, in my mind, you got to be of two minds of gold. And the way you put it is perfect. There's the insurance side and there's the investment side. There will be a time when I'll go down to my minimum of gold in the investment side, which is 5%. That time is not now for me. There will be a time I will do that. I don't know when, but you look at after this run it's had, let's say it runs to 10, 12, and things start to stabilize in the world. We get through fourth turning, what have you. There will be a period of time, some point in the future, maybe after we're dead, right? Mm-hmm. That scenario will set up. But the prudent thing to do as an investor is, okay, how is this? What parameters am I looking for to warn me to go from, say, overweight gold to target weight? Let's say my target weight's 20%. Okay. Maybe I'm 30% right now because it's having a great run. Will there be a time I go back to my minimum of 5? There will be. What parameters should I be looking at to do
that? Here's another one we could put up on the screen, and that is gold relative to Bitcoin. Because as gold went parabolic starting in October, Bitcoin has lost 50% of its value. There are crypto people with literally that need to that got teeth marks around the barrel of their gun right now, that they're losing their ass. And I think the day of crypto is probably waning, because they realize it's a fugazi, it's a wazi, it's a woozy, it's fairy dust. And it's not on the elemental charts. It does not exist.
And, I can trace that back. I can't tell you the date, but I can trace you back to the event. And this goes to, what parameters are we looking for to tell us something's a good investment or a bad investment? I look at the bigger parameters, or I try to, okay? I can tell you in my mind, when Bitcoin stopped getting out of the system, all the arguments were made for Bitcoin, and when it became not that. Right now, where it wound up at is it's a liquidity proxy. It's the NASDAQ on steroids with leverage. And that's how it trades. If you look at a chart of Bitcoin to the NASDAQ, they almost track perfectly. When there's excess money in the system, throw it in Bitcoin, it's speculation. And when Bitcoin stopped being what it was intended to be from the white paper, from what's his name, was when you started getting ETFs, futures trading, government regulation. It was done as that.
Yeah.
So, and I'm thankful to say I was short Bitcoin at 110.
Good call.
Okay. But that again, that's the, whether, I mean, there was a period of time in there, I shorted gold miners too.
Mm-hmm.
Now, and gold miners are a great way, guys. If you're going to have a precious metal part, gold miners are basically a levered play on the underlying metal, just like silver miners are, because suddenly their reserves in the ground, the mineral rights they have, become worth a lot more when gold goes from 2,000 to 5,000. Suddenly, those miners, their stocks explode.
Yeah.
So it's a way to lever gold if you see that coming. It's also a way to short those. There's ETFs out there you can short gold miners. So you can play both sides of that. So, yeah,
I'm more, me and Tony are on the same page. The 3 B's of economics: bullets, beans, and bullion.
Yeah.
Well said, sir. Well said.
Ways to play all that. So, let's see here. I'm curious about Michael's. What is the current capacity of existing miner operating? I'm going off some old reading, Michael. I want to say they produce about, well, what they put out on the market is about 2 to 3% of the world's gold supply every year. Now that they could be holding back on capacity. In other words, they could have more capacity sitting on the ground and just be holding that back to help support the prices, much like oil companies do.
Looks like the last data is from 2024, 3,300 to 3,600 tons a year.
Okay. Yeah.
And that's yeah. So China, Russia, Australia, Canada, and the U.S. is top producers.
Yep.
And that's a plateau from 2016 levels.
Yeah, and China's 3x us, worth 158 tons a year based on little Gemini here. And
that's right.
China's 380.
Yeah, exactly.
And there's what, I'll use the average of those numbers, brother. 60,000 tons above ground right now.
Mm-hmm.
So math in public, stand by. So the production of these top countries is about 1,300 tons a year divided by 60,000 tons. So they're adding about 2% a year.
Mm-hmm.
So, and this has always been this why gold was money, right? Because it was limited how much would come out of the ground. Mm-hmm. So it put a natural limit on the money supply. The only problem is politicians don't like limits on that.
No, they don't. That's why they ran from it.
Exactly. So
I'm a Ron Paul Republican, man. So we're all about getting gold back in the system.
The only thing I'm gonna throw out there is think that through. Mm-hmm. Because a limited money supply also means limited economic growth, limited opportunity. Everybody thinks about, I want sound money. Well, without sound money, or with sound money rather, you would not have 1982 today in the economy.
That's right.
So the economic growth we've seen, all that, it's think that one through.
Well, I come from a long line of, poor Scots Irish farmers, pastoral people, agrarian people. I don't have I live on a farm. I don't have a freaking problem with that. I don't come from the speculator class. And if I did, maybe I would look at it differently, but just saying.
And I take your point, but if we start truly limiting money supply to 2% a year, mm-hmm. Would probably make the Great Depression look like a walk in the park.
Well, we just wouldn't be able to afford 200 something bases around the world. We wouldn't have, we couldn't be the world policeman. We'd be more isolationist.
Yep. And that's true, but there's going to be a lot of economic pain here for everybody,
mm-hmm.
With that. So it isn't just, we got sound money, everything will stay the way it is. It's going to cause
you got a limit on it.
Yeah. So there's going to be a lot of pain there. So, all right. This has been 49 minutes. Maybe we should get to the slide deck. All right. So to our speculating thing, there are now more ETFs, exchange traded funds, than there are stocks. First time ever. And a good chunk, and I believe it's the majority of ETFs created in 2025 were leveraged or single stock ETFs. And if it's a single stock ETF, it is leveraged. So you can buy TSLL, which I believe is a 1.5 or 2x on Tesla. So they're doing the leverage inside of there. They're using call options to do that. And you can also buy TSLQ, which is a 1.5 or 2 short on Tesla stock. So you don't even have to be authorized within your account to buy options or short something to do it through there. There's ones in there. GGLS is good. The Google short. We could rattle through a bunch, but you guys can look them up if you're interested in any of those. Point being, if we look at a stock market chart from the last 3 years, 4 years, since 2021, really, leverage is great on the way up, not so great on the way down. See also the silver chart from last week, and that's what happened to silver when it went from 120 to 80 or whatever it was that day, 90, I think it was actually. That was leverage unwinding. So leverage is great on the way up, not so great on the way down. And eventually these ETFs are going to come back to bite, because let's say, Rich gets his gambling hat on, he buys some TSLL, the levered long on Tesla, and Tesla burps. Okay. And Rich bails. Hey, I'm at 30%. I'm out. Okay. Well, when you sell that, they're also unwinding the options position within that, which then levers Tesla down. What this eventually brings about within a trade is volatility. And then Tesla, let's say this happens across tech, as we're seeing. I mean, look at the last week. There was a lot of pain in tech in the last week. As these things unwind, it starts to affect the major indices. People get nervous eventually. So far, retail is still buying the dip. But retail starts selling off in their 401ks, IRAs, and then you get as Mike Green calls it, the giant mindless robot, where when somebody sells $10,000 worth of their S&P 500 fund, they go in and sell those stocks. There's no active manager going, well, no, I think this one's good. Let's sell that one. No, they just sell everything, or they buy everything. There's no, hence his name for it, the giant mindless robot. The passive bid will come back to bite us eventually. So, yeah.
This is interesting. I would have not guessed that, but
and there's ETFs out there. Oh my gosh. I mean, there's a double long on silver.
You talking about meme crap. I mean,
oh yeah, for sure. And you'll see some crazy stuff out there. There's a Mag 7 ETF where basically you buy a share of that, or $10,000 of that, or whatever your number is, and it goes out and buys the Mag 7. There's a little bit of everything out there. And then you've got levered long, levered short on those as well. So
I was stepping into an elevator the other day, and the elevator operator was telling me some really good ETFs to invest in. I'm being a smart ass, but
how about the shoe shine boy? Was he telling you
that's I've heard different versions of that story. One, it was an elevator operator. One's the shoe shine boy, but
I've always heard the shoe shine. I didn't hear the elevator operator, but I'm sure it was happening with those guys too. I'm sure the elevator guys heard a lot of talk. As
they did.
Yep. This is one I came across this chart from Wolf Street. They're a little more well, I shouldn't say a little more. They're out there on the everything is gloom and doom scale. So take it with a little grain of salt, but numbers are numbers. This is office mortgage-backed securities, commercial mortgage-backed securities. Delinquency rate as a percentage of the total loans outstanding. And that's pretty darn high. Now, you hear, the scariest thing you hear is this time is different and so on and so forth. This one, there might be a little asterisk by that with all the work from home stuff, because there just isn't demand for office space like there used to be. Maybe the trend is still there. We can't deny that, but you can also look at where it started coming up. That was after the work from home started during COVID. So I'm not calling for Armageddon based on this, but I'm keeping an eye on it. A very loose eye. So yeah, take that for what it's worth. To Tony's thing, that was Joe Kennedy, the shoe shine boy.
Yeah.
Yep.
So we remember E.F. Hutton from the 80s, right? When E.F. Hutton talks, people listen.
Yes, absolutely. So,
and I think there's something to that today, man. It's no different than maybe the Doge to the moon, man. Oh, really? Oh, cool. Good for you. Now go sell all my crypto.
Well, and there's there's games to be played within that, right? So,
I'm not a gambler, Brent. I'm not. Just never going to be.
Yeah, that's cool. That's fine.
Yeah.
This is one Kobesi letter. I'm going to lean heavily on them during this show, and really going forward. I found them to be a really good source. Americans are worried about their jobs, and this is all spending at the end of the day, outside of your food, clothing, shelter, right, and even within there, sometimes is emotion driven, right. And so this is the importance here is the perceived probability for households to find a new position in 3 months after a job loss is down to 43%. So in other words, it had been running much, much higher. Like, oh yeah, I can go find another job. Now people are starting to get nervous about being able to find another job if they lose their job. Okay. Mm-hmm. And you see there is down 15 points. So it was at 58% in May of 2022. And you remember that was the quitting cycle, right? The quiet quitting and all that stuff.
Mm-hmm.
So, and in comparison, the 2020 pandemic low was 46%. So we're below where people thought they could find another job within 3 months during the pandemic. Okay. So, and add to that, the perceived probability of losing a job over the next 12 months is up to 15%. One of the highest since the pandemic.
That's not a lot of confidence, bro.
You've got more people fearing that they're going to lose their job, while at the same time, more people are saying, I couldn't find another job within 3 months. And the key word out of this is the first word of the bottom paragraph, anxiety.
Yep.
And when people start feeling anxious, they stop spending. So
it'll be time for a stimmy to get them going again.
Yep. So see also debasement trade. So this is something to keep an eye on. This is not new. This has been going on. Let's bring Alan's comment up because this is a good one to dig into for about 30 minutes or so here. What about the perception of AI eliminating jobs versus AI creating jobs? I see this kind of as let's think about the .com era, and let's also think about the money printing that you and I were screaming about in 2021 and how this is going to cause inflation. And you and I were like, this is going to cause inflation. This is going to cause inflation. And people, 30 days later be like, see, no inflation. We're like, well,
and then when it came, we were told it was transitory.
Exactly. But the point is people don't understand these long and variable lags, as is said, right? Because there was such a lag between the start of the money printing and when people really felt the inflation, say going through 4 or 5% on its way up, that most of the population did not put those two things together as cause and effect. It was, Team Red did this or Team Blue did that because there was enough time in between. Let's also look at the .com bubble in that the infrastructure that was built during the .com bubble, all the fiber optic, we're still using that. So part of that bubble was the infrastructure that we're still relying on to do this show and run everything we just consider normal now with the internet. So it's a lag thing, right? So is AI going to eliminate jobs? They're finding out it's not eliminating as many as they thought it would, but I think that will come. Okay. But then let's think about when the .com bubble burst, a lot of jobs got lost, right? But then that also set up the infrastructure for YouTube, for Google, for Amazon, especially Amazon Prime, the streaming stuff, right? But it's such a long lag there that we don't really put those together. And there's pain in between. So that's what I think will happen again, generally speaking, with AI. But it's going to take years and years to play out.
Yeah, it's good. I'll go with that. It's good analysis.
Thank you. So, also from Kobesi, student loan delinquencies. Now, part of this is because they're shockingly being made to, make payments.
What?
I know. Silly talk, right? We don't do that in 2026 America. All right. And what I'm going to draw your attention to here first is the red one. The number of federal loan recipients, 271 plus days past due, is now 8 times higher than the pre-2020 average. That was before they started doing the you don't have to make your payments thing, pre-2020, right? So And 271 days, that's 9 months, guys. That's a long time without making a payment. Let's go back to people feeling fear.
Yeah.
Right. Okay. And
8 times, bro. That ain't
1x. Exactly.
That ain't 2x. 8x. Are you freaking kidding me?
Now, the second one there, this comes as the grace period ended in June 2025 when missed payments began appearing on credit reports. Let's think about that. June 25, June, July, August, September, October, November, December, January. That's 8 months. So basically, they never started making payments again.
Right.
So it will be interesting to see what happens with this number as we roll forward here in the next few months, see if this keeps going up. Because this would be people not able to make these payments. Because what did they do? They started running their lifestyle around not having that payment.
That's correct.
Right? Also see BNPL, see credit card balances, see all these other things. See $1,000 a month car payments, very common now, right?
People buy the payment, man. That's what they did when they bought when they got that student loan.
Right. And I don't think I put in the slide deck, so I'll mention it now. Affirm, one of the biggest BNPL, buy now, pay later firms out there, is figuring out how to create the structure so people can use BNPL to pay their rent.
Oh my God.
Mm-hmm. Yep.
At some point, this is parasitic.
That tells me they see a demand out there for it, right? Yeah, and you're right, it's parasitic.
Yeah, it is. I mean, a lot of these things are just taxes on people that are bad at math, you know?
Yep. Absolutely.
And I hate to say it, think of the dumbest person you know and remind yourself that 50% of Americans are dumber than that person.
Mm-hmm.
And that's just a fact. And then you go, well, why the hell would anybody do that? Oh, yeah, that's right.
Yep. So, So I'm not going to bore you guys reading all this to you. This is 2024-2025 data. Student loan delinquencies are more common among lower income borrowers. It lines up, right?
Mm-hmm.
But here's the part I do want to talk about, the growing trend here in red. Recent high income borrowers are actually 45% more likely to be overdue compared to their own 2019 levels pre-COVID, right?
Mm-hmm.
Their payment behavior, despite higher earnings, more than 54% of the highest income households did not make any payments immediately after the COVID-19 pause ended. So that's great, gee whiz. But let's remember our K-shaped economy is 70% of our economy, 67%, pick your number, 70% of our economy is consumer spending. The top 10% of income earners represent half of that. So the top 10% of income earners are 35% of our GDP. 35% of our economy is their spending. If suddenly they get forced because their paychecks get what's the word I'm looking for? They pull the money straight out before they even get it. Garnished. Their paychecks get garnished to make these student loan payments. What happens with their spending? What does that do to the economy? That's the part I want you guys to think about and look at. So this is something I'll be keeping a loose eye on as stuff comes up, and this will be a process over time.
Right.
But this is another one where people high income earners can be irresponsible too, right? Just because a person makes a lot of money doesn't mean they're good with money. See, also doctors. Okay.
Yeah.
Doctors are notoriously bad with money. Okay. What's Dr. Fuller saying?
I love this comment. Nobody ever went bankrupt betting on the stupidity of people in groups. I mean, I've heard it said, pawn shops never go out of business. Payday lending never goes out of business. I mean, P.T. Barnum made himself wealthy betting on the stupidity of people in groups.
Another way to play that, coming into the fourth turning, hashtag not financial advice, Axon. Alpha, X-ray, Oscar, November. Make tasers, dash cams, body cams. Just saying.
Yep, going up.
So, what's Ted say? I like that.
Me feels politicians making promises incoming. You are correct, sir. Stand by.
And bear in mind, this stuff's only going to get worse as we move into the fourth turning. Now, let the economy take a little burp here for some reason. Any reason. And that we're setting ourselves up. Same way, those of us with the tinfoil hats called the housing crisis ahead of time because you could see the trend. What are we seeing here? Seeing the same thing. People are loaded up with debt payments, and alternative debt like buy now, pay later, where that's not in the credit reports to my knowledge yet. There's talk of it. There's been talk of it for over a year, but as best of my knowledge, it has not hit yet. So if that hits, because I mean, put yourself the bank of Rich, okay? I come in there and say, hey, Rich, need a loan. And you go, well, show me your credit report. Show me your, whatever you look at, right? Well, I could have a bunch of BNPL stacked up on there that
you're never going to know.
I don't disclose to you and you can't find. So you're not lending money based on full knowledge, right? And you may have on your form, do you have anything else? And I put no.
Right? This is the Wild West of buy now, pay later.
Yeah.
This will be cleaned up in a few years. I really think so.
It will be. Same way the excess in the housing market was cleaned up in 2008. And it always gets cleaned up the same way. And I forget who it was. I didn't come up with this. All debts are eventually paid. Sometimes it's the bank who lent the money out, right? But all debts are eventually paid. And this one's going to go that way. Speaking of that, interest payments to foreign holders of U.S. debt. That looks like Al Gore's hockey stick right there. And the reason I bring this up isn't, scary, whatever. The argument has been made for a long, long time, more so by Team Blue, okay, but somewhat by Team Red as well, is, the national debt's huge, it's out of control and all that stuff, but we owe the money to ourselves because the biggest chunk of it was the Social Security Administration purchased U.S. Treasuries. There is no Social Security lockbox like Bill Clinton talked about back in the day, okay? So the point is, we owe the money, but we owe it to ourselves. Well, that is changing.
Yeah.
Okay. And, China's not buying the debt like they used to and so on and so forth. The biggest
Japan, isn't it?
Yeah, look at you go. Yep, Japan. How's their economy doing?
I know. Not good.
So they have their own problems with their debt is insane and their demographics are awful. So we'll see how that shakes out. So we need other countries to be buying our debt to keep this going, right? Otherwise, we will eventually get into
this is unsustainable, folks. By the way, go back to Tony's comment. Beans, bullets, and bullion.
Yep.
This is unserviceable, unattainable.
Yeah. Acceptance.
Sorry.
Yeah. Yep.
Heard it here first.
So
what's the time horizon is the one we don't know.
Okay, so here's the question. Which country or countries should we be cozying up to buy our debt? Think demographics.
India.
Bingo. Yep. Next slide, please.
Ooh.
I think I got on the next one.
Okay. Yep, there we go.
Who's India making friends with, though?
EU will cut tariffs on cars. India's making trade deals with the EU, and Canada is making trade deals with China. Yeah. Which is weird. I mean, the EU, are you kidding me?
Yep. But the point is that
I heard that France has like the same GDP as Mississippi. Am I off on that? Or is it the UK? One of those.
One of those, I would believe that. Either one off the top of my head. I mean, they're not. We're actually, you sure you didn't look at this slide deck?
I swear to God,
good. You're getting good, brother. We got a little France thing coming up here, okay? India has reached this trade deal with the EU. Okay, so is that going to replace trade with US? No, not even close. Okay. To your point about France.
I just Googled it, by the way, brother, and it actually, the UK GDP is roughly comparable or slightly lower than that of Mississippi, which, oh, by the way, sorry, Ted, but it's the poorest country in the union. I mean, the poorest state in the union, sorry.
But let's also look at this, how the news media covers this. If the UK comes out and says, we're not buying US debt anymore. Okay. I mean, is it good? It's not good, but it's not going to crash our debt markets, right? Yeah. Whoop-de-doo. It's like who was it it was Denmark who sold off their US treasuries because of the whole Greenland thing, right? Denmark's total holdings of U.S. Treasuries was like the daily float on U.S. Treasuries. It's like, okay, thanks for playing. Okay, one day and it's taken care of. Not saying we want to run around and just make people angry, because eventually you run out of people to make angry and you got a real problem, right?
And that's where we're heading.
But that's my point with this is India's being smart and they're being multilateral here. So, but
they
we
got
need
1.4 billion freaking people, man.
Yep. And it matters who cozies up to India. And India, they're not stupid. Okay. So this is something we need to keep an eye on overall. And we will see this play out in the news cycle with Trump just threw some tariffs on China and Russia, didn't put them on India. Right. And he makes deals with them pretty quick. Okay.
And he turns a blind eye when they make deals with Russia and shit like that.
Yep. And he opened the Venezuelan oil up to India real fast. So Russian oil, they will stop buying Russian oil because he gets a twofer out of that, right? India becomes dependent upon us through Venezuelan oil and cuts ties with Russia. So there's a 3D chess game going on within these little news blurbs that we read and go, oh well. Okay.
Ooh, there's France.
Yep, there you go. What's
Emmanuel Macron?
Yeah, what's he have to say there?
In France, we believe in science. That is why on May the 5th, I issued a clear and open call to the world for science. Choose France. I'm very proud to see that this call has resonated so strongly. Around 40 leading researchers have chosen France. Through France 2030, we have invested more than 30 million euros to advance health, climate action, artificial intelligence, and fundamental, I can't read the rest of
sciences. Yep. Okay. So 30 million pounds.
Wow.
Big whoop.
That is nothing, folks.
NVIDIA makes $354 million in profit every day.
And this is through 4 years.
Through 4 years. And it's not just AI. It's also climate action and fun. Let me guess where the majority of that money's going.
This is laughable, man.
I'll put $20 on where most of that money's going. Okay. $20 is also like, I don't know, half the France GDP. So this is again, one of those things where, the news will tout this. Oh, they're starting this initiative. Math matters. Okay. So, but again, this is as you're consuming the news media's regurgitations on stuff, guys. Team Blue media will play this up, right? And Team Red media will basically ignore it because let's face it, even the vast majority of people consuming both sides of the media, they're looking for their own version of red meat. This isn't red meat for Team Red media, right? Because it takes too much explaining.
Yep.
Okay. So we want to be above that. We want to do better for our families, right?
And France GDP is roughly Texas.
Yeah.
So.
Yep.
Well, not as pathetic as the UK, but pathetic.
So, and Texas, I'm sure, has better barbecue.
They most certainly do, sir.
Yep. All right. What we got next? I can't remember. Okay.
Out of the money over covered calls.
We're back to our covered calls here. So little refresher on stuff, and then we've got a couple.
In the shooting world, what does OTM mean? Open top match.
Oh, I've never heard that.
Yep.
Is that
basically a hollow point raffle round?
Oh, gotcha. Okay. All right. What's Dr. Fuller say?
Does math really matter for those bashing decisions entirely on feelings and sound bites?
No.
Hell no.
Nope.
I wish it did. It does not.
It does not. And it's like every now and then, if I'm feeling a little spicy, if somebody says, "How are you?" I'll use George Carlin's old bit and I'll say, "I'm not unwell, thank you," because that makes them think. So, so out of the money covered call. So quick refresher: covered call is when you own the stock that you are writing the call option on. So I own 100 shares of NVIDIA. I sell that a call option to Rich, and it's covered by those shares. So if it gets called away, my 100 shares get sold away, but I don't have to come up with additional monies. Okay.
She didn't do it naked.
Yep. No, that's a great way to lose a lot of money is selling naked calls and naked puts.
As you taught us last week. See, I'm listening.
Yep. Look at you go. The big words don't slow you down one bit.
No, sir.
I
hear naked and I key in, bro.
I knew I could count on you for that. Yeah. All right. So OTM out of the money. Okay. Mm-hmm. And so this is where the strike price, if you will, the activation price for the option is above the current strike price. So if XYZ stock is at 100 and you're technically anything above 100 would be out of the money. But typically speaking, we're talking a fair amount. There's no set number. Okay. So if it's at 100, maybe I start calling it out of the money at 103-ish in my own mind, right? Definitely like 110, 115, 120, you're out of the money. Okay. More out of the money is safer. So if I own XYZ stock at 100 and I sell Rich the February 13th call for 150, that's very safe for me. The chances of it making 150 in a week, not good. That's a 50% gain in a week. Even if you got NVIDIA, not a great chance of that happening. But Rich, how much are you, relatively speaking, how much are you going to pay for that 150 strike price a week from now? Little to nothing, right?
Mm-hmm.
So therefore, I don't get a lot of premium out of that. The money you pay me to have that option is called premium. A lot of guys in the world call it the juice. Okay. All right. Less out of the money is less safe for me, meaning there's a better chance of it getting called away from me, but there's a lot more premium there, right? Because there's a better chance of you getting a chance to profit off of, say, a 105 call in a week. That's a 5% gain in a week. If we're talking about a tech stock, that's pretty easy to do, right?
Mm-hmm.
So let's remember that options are typically speaking, the people buying an option are gambling. And sometimes I do that. I'm not going to tell you guys how to do that. There's plenty of YouTube videos. I don't want to take anybody down that path, okay? Because that's a high risk, high reward game. It can also be a high negative reward. You can lose all your money, which I do fairly regularly in there, okay?
Mm-hmm.
But it's a way to also put a little bit of money in and get a whole lot of gain, okay? But you can lose all of that money. So therefore, keep your position sizing responsible. You hear about people losing their entire portfolio in options. It's because, let's say, they say put 5% of your money in XYZ stock. Well, if you do 5% in options on XYZ stock, now there's a chance you lose all 5%. Whereas if you put 5% of your money in XYZ stock and it goes down 20%, now you're only out that, right? Options don't work that way. Now you can resell them for a partial loss or some gain before the expiration date, but that's a whole different game. We're not going there. Okay. So these covered calls are not that big scary thing. As we covered last week, the worst thing that can happen is you lose potential gain. Okay. Let's look at a real world example here with QQQ, the NASDAQ ETF. All right. So I'm going to expand this so my old eyes can see this. So these are the actual numbers from last Friday. At the time, QQQ was at 609.54. You can see there at the top. This is the February 13th call options for QQQ. Okay, now it's at 609.54, 610 there, as you can see on the red one. That's pretty much at the money, right? We can call that at the money. Okay. You agree? Okay. Yep. So if it makes 610, I have 100 shares of QQQ. All right. You want to buy the option to purchase that at 610 by this coming Friday, February 13th. Okay. And I go, yes, I will do that. And you'll see there the red box, the last trade on that when I grabbed this chart was $7.13 a share. So you're going to pay me $7.13 a share. And we'll remember that each option contract is 100 shares. So you're going to pay me $713. Okay. No matter what happens after this, I keep that $713. Okay. If it makes $710, I thought you
kept $100.
What's that? Oh, that was because last week when we did the generic one, it was $1 a share we used.
Oh, okay.
So it's that price times 100 shares. Okay. So in this case, you'd pay me $713 to have the option to purchase my QQQ shares by Friday, not on Friday, by Friday. Okay. For 610. Okay. Now in reality, your break even there would be 617.13, the 610 plus the 713. Make sense?
No, the dogs were barking. So,
no worries. No worries.
So I'm giving you $713.
Okay. Now let's go. Let's do it on a per share because it's easier to visualize, I think. Okay. So you're paying me $7.13 a share for the 610 option. So your true break even, it has to get above 617 and 13 cents because you got to get your $7.13 back. Mm-hmm. Okay. So let's look at it from my standpoint. I could, if the Qs go up at 610, you could say I want them, and I have to sell them to you for 610. I get no choice in that. It happens automatically through Fidelity or whoever you use. It just happens. Okay. So if we look over here in the red box, it limits my upside gain on QQQ to 46 cents a share. Okay. Times 100 shares because an option contract is 100 shares. That makes me 46 bucks. Mm-hmm. My covered call gain is $7.13 a share, $713 for a total gain of $749. Okay. Let's look at the yin and yang of this though. What happens if the Qs go to 650? I missed out on 610 to 650. Mm-hmm. Now, I did not lose money. I made $749, but I could have made a lot more. Okay. This is the downside of a very close, say at the money covered call, is you could miss out on potential gain. Okay. What if it goes down to 600 though? I keep the $713, the $7.13 a share, and I lose, if you will, my account balance goes down because I don't have to sell my QQQ. When my account balance goes down by $9.54 a share, right? But I've got so I lost $954, $9.54 times 100 shares, $954, but I still have your 713. So I buffered some of my loss, right? Mm-hmm. So there's the back and forth. I mean, if it goes down to 500, I'm going to eat that loss, but that's the same loss I would have had if I would have just held the stock, right? Yeah. But I still, either way, no matter what happens, I keep your money. Okay. So then the question becomes, why would you do this? Why would you pay me? That's
what I'm thinking.
Okay. Well, do this? What if it goes to 650? You bought it at 610. Mm-hmm. So now $40 in profit. We're going to keep it simple here. Okay. $40 in profit times 100 shares is $4,000. Mm-hmm. You put $713 in and walked away with $4,000. You've levered it up. Mm. This is where I sometimes buy naked calls. I buy them. I don't sell them. I buy them. If I think something's going to move in a period of time, you can buy these for the ease of argument here. Like the Qs, you can buy daily. Okay. But let's say we have a big pullback in the NASDAQ and we think we're going to, whether it's a dead cat bounce or a real bounce off of a dip, and we think in a month it's going to be considerably higher, buy some at the money calls. You can turn your $713 into $4,000. Not a terrible return, right?
No, it's a solid return.
Okay.
If you guess right.
Exactly right. Because you don't know which way it's going to go. But this is also a way, let's say I think it's going to go up. Okay. Because you're a conservative guy, right? And you go, you know what? We've seen this go down. Heck, make this GLD. Let's put it into your pet rock zone here. Okay.
I'll buy all the pet rocks you want to sell me, brother.
Okay.
Open that safe up. I'll come up there and pick it up.
Make this make this so make this GLD instead. Mm-hmm. Okay. GLD takes this 10% pullback we were talking about earlier. And you're like, I don't want to, let's say it's I don't know what GLD is at. Let's just say it's at 500. Okay. This is the ETF. Okay. Mm-hmm. Let's say GLD is at 500. And you're like, ooh, I don't have a lot of extra money right now, cash on hand in the accounts to put into this, but I do believe it's going to go up, say over the next month. You could buy option contract on GLD for a month out, say at the money, right? If it goes down some more, right? then you're going to lose whatever that money you put in. In this case, $713, right?
Mm-hmm.
That's all you can lose. You can't lose any more. But if it goes up, you can make a big profit. And this is why I will sometimes buy naked calls, because I can limit how much money I put in, but I can make a lot more. Okay. In this case, if I wanted to buy 100 shares of the Qs here at 609.54, I need basically $61,000 to do that. Right.
Yep.
Or 713. So let's say I'm wrong. Let's say it does go down to 600. And I'm the one sitting here now going, hey, I'm either going to buy 100 shares of the Qs. It's going to cost me $61,000 to purchase them. Or I can buy the option for $713. My max loss on the option is $713. What if the Qs go down 10%? And I put 61,000 in. I'm out $6,100, but the most I can lose on the option is $713. This is where options become a good thing. Where they become a bad thing is when people start chasing. I'll put some more in. I'll put some more in. Oh, this is going great. I'm going to do some more. See also the silver chart.
Yep.
Okay. That's where people get themselves in trouble with options, is lack of discipline. Also, the worst thing you can say to yourself when you're trading options is, oh, I got this figured out.
Ooh, no.
Don't do that. Okay. The other thing I want to touch on here is the red circle, delta. Okay.
Mm-hmm.
This is think of this as the percentage chance that this is going to, this option contract is going to work out for you. So in this case, it'd be 48.94%. Call it 49%.
Mm-hmm.
You'll see that the at the money option is basically a 50-50 bet. Okay.
But how are they calculating that, bro? Yeah, that's what I'm trying to figure.
This is called, we do not want to dig into this math. It's out there. It's called the Black-Scholes model. Okay. The guy who came up with it won a Nobel Prize for it. Think of it as, so I'm going to go over there and then come back. Poly markets. You familiar with poly markets?
No.
Okay. It's a website. You can go in there. You can bet on anything. You can bet on who's going to be the next Fed chairman. Like, there's a market for anything you want to bet on. And it goes back to, I watch poly markets. It goes back to way back when there was a farmer. The story goes, there was a farmer that used to take his cows to the fair. And then he was like, you know what? I'm going to have some fun here. So he started a little competition. You put your nickel in the jar and guess how much the bull weighs. Okay.
Mm-hmm.
And when a few people would do it, nobody would get within the, whatever, 20 or 50 pounds or whatever, and everybody lose their money. But the more people who did it, eventually you'd have a few knowledgeable people who would put their money in. And then more people would go, it kind of a herd mentality. But what would happen is a lot of people would cluster around the correct answer. Think of, that's poly market. So I'll look at poly markets because there's going to be a few knowledgeable people who go in and bet on these things. And then as more of those people do that, because it's a good bet for them, right? The other people will see that, and you'll end up with probably about the right answer. Is it always right? No. Poly markets had Kevin Warsh being the next Fed chairman at like 4% or something. So it's not always right, but it's something to look at. Okay. It was a real surprise. I'm really surprised Trump picked Warsh because everybody expected him to pick somebody who would just print money. But think of this as that. So basically, if more people are buying and selling options in a certain zone, there's going to be a better chance that it gets there, right? Because the market knows something. And overall, the big market pretty much knows stuff, okay? If we'll jump ahead, go all the way to the bottom there, your QQQ call for February 13th at 625. Okay, that'd be a 4% gain in a week. That's a pretty solid gain for the NASDAQ, right? Look at the percentage chance of that happening, 14.67%, call it 15%, right? So the further away you get from the money, the lesser chance that is going to happen. Makes intuitive sense, right?
Yep.
And therefore, the option is also priced there. So if we go to our next one, I just picked middle of the stack here, the 617 call for February 13th. That's $3.60 a share. That's basically half the price of the at the money one, right? Because there's less chance it's going to go to 617 than 610, right? So therefore, you're not going to pay me as much for that option because there's less chance that it gets there, right? Okay. And you can see that there with the delta. Basically, let's just call it a 33% chance that happens. Okay. You can also look at the volume on the next one over. Go back to our 610. You got 11,775 options being traded at that, and only 1,056 at 617.
Right.
Also, notice something funny about human psychology. Look at the 620. Humans like round numbers.
I know.
Humans like round numbers. Use that knowledge when you're doing things. Right? Okay. So let's math out this 617. Let's say it goes there. Okay. So you're going to pay me. I own the Qs. You want to buy the option. Okay. You're going to pay me $3.60 a share. Okay. That's $360. No matter what happens after this, I keep the $360. Okay. And it has to make 617 for you to be able to exercise it. Right.
Yep.
I get to keep the difference, 609.54 to 617, saving the math at $7.46 a share. Okay. So I get that 746 and I keep your 360. So if that happens, if it goes up that much, I make $1,100. Okay. Let's say it goes to 650 again. Okay. Now you get from 617 to 650. You get to keep that, right? That is not as good a return on investment for you, right? Because there was a lesser chance. I shouldn't say it that way. This was not necessarily as good a bet for you because there's less chance it's going to make 617, right? But you had to put a lot less money in, basically half the money, right? But you're getting the majority of the gain, right? So if I bear with me one second. I'm going to get my calculator up because I failed to do it on this. So you got 650. You're going to make $3,300 on that, right? So you're going to make $3,300, but only had to put 360 in. You 9x'd your money. So your return is actually better than buying the at the money one because it was more of a gamble, right?
Right.
Okay. So this is where the options market can be played. Let's say you think silver is going to go back up to 125 where it was before it came down, right? There's less chance of that happening than say it going to 80, which is about where it is now, I think, right?
Yep.
Well, you're going to pay less for that option for silver at 125, say a month out. There's less chance of that happening than going to something closer to the current price, right? But your profit is way bigger. And the amount of money you have to put in is way less. In our example here, between 610 and 617, you put in basically half the money and made more. But there's also a better chance you end up with zero. So think of it from a gambling perspective as far as percentages, odds, your gut feel. Just intuitively it makes sense, right? It'll make more sense when we do this next one. 625 in a week. Okay. It's got to go up about 4% in the week, right? That's a big move for the NASDAQ for a week, right? And we can see that in the delta. Only a 15% chance of that happening. Okay. You'll also notice, look at the difference in the volume between 624 and 625. Humans like round numbers.
Right.
Okay. And the market is made up of humans. Okay. All right. So now, if you want to purchase the 625 option from me, it's only going to cost you $1.12 a share. So you're going to pay me $112. I keep that after this, no matter what. Okay. However, let me math again. So it has to make 625 for you to exercise that. Okay. So I would get the gain from 609.54 up to 625. So I'd make $25.46 over there. You can see that in the yellow box. I'd make $2,546 in that period of time. Plus I keep your 112. So I get $2,658. Now that sounds great. Oh, you made $2,600, but there's also less chance of this happening, right?
Correct.
So this is what this example here is. If you bounce around YouTube, you'll hear people saying, sell covered calls is a great way to generate income on stocks you already own. Mm-hmm. This is generally between the orange and the yellow box. This is what they're talking about. They're talking about selling far enough out of the money. And this is where the game comes in, right? I want to get closer to the money. I make more money, right? There's a better chance of my stock being called away.
Mm-hmm.
But if I go far enough out like this, I can put a little money in my pocket, put $112 in your pocket, right?
And the risk is incredibly low.
15% chance according to the market.
Exactly, yeah.
Now, is there a chance it's going to go to 630 and you have to sell it at 625? Yeah, yep. That's the game. Could a person also...
But you still made money.
Right? Absolutely correct. But could a person do something like this? Let's say you bought 300 shares of the Qs. So you're big money guy. You got 180 grand you're going to put in there, right?
Mm-hmm.
And you sell one covered call at 610, one at 617, and one at 625. Now you've brought in 1,073, 1,173, $1,185 in a week. Will the at the money one get called away? I mean, basically a 50-50 shot, right?
Uh-huh.
How about the 617? A little better chance. If it goes down, you have lost the same amount of money you would have lost anyway, but you kept my premium.
Mm-hmm.
So this is referred to as laddering. You're laddering covered calls. So you can use this to generate income off stocks that you already own. And by doing this, you've got one that's a 50-50 chance it gets called away, but you make more money. Okay. So this is and people will get all freaked out. Oh, my stock got called away. My attitude is, so what? If you like it, buy it again. Because when that gets called away, you get the money for the stock purchase at 610, 617, or 625, depending on which example you want to go with. You get the money, so you can rebuy the stock. Now, in fairness, if the Qs go to 650, I'm only going to pay you 610 or 617 or 625. So you'll have to put some other money with it to buy it again. Full disclosure, that's the downside of the risk. But this is a way to generate income off that. And you can, like for the Qs, these call options are bought and sold daily. You could buy one right now for the close of business today. Or you can go a week out, a month out. You can go a year out. You can even go 2 years out. Okay. I don't like going further out like that, simply because now I have to hold on to the stock for that whole period of time that call option is out there. Let's say it goes down 50%. I want to get rid of it. I have to buy that call option back.
Okay? Oh,
wow. But it's going to be worth, if the stock goes down 50%.
Do you break even at that point when you buy it back, or no?
Well, let's take our top example here. Let's say the at the money one. Okay. So, and this is a good one to look at short term. So just don't overthink this. Just do it intuitively. Let's say today the NASDAQ crashes to 550. Okay. Actually, let's go 540. It's down 10% today. Okay. What's going to happen to the value of the 610 call for this Friday? Is it going to go up or down? What's the probability of it going back up to 610 by the end of the week if it's at 540 right now?
Low.
So what's going to happen to the value of that option? It's going to go down.
Yep.
Right? So instead of it being worth $7.13, maybe it's worth $2. Right? So you're still going to pocket $500 of that, because when you buy it back, you'll pay market price. Does that make sense?
It does, but I hear this and I go, freaking, this is gambling stuff, man. I mean,
well, it is, but the nice thing about this, so gambling would be, I'm going to buy Qs with a plan to hold it for the week because I think it's going to go up. It's a 50-50 chance, right? Either it goes up or it goes down. You only got two choices, right?
Yeah, red or black. Spin the roulette wheel. What do you want to do?
But let's say I buy it at 609.54 and I sell the 610 covered call on it. Still a 50-50 chance it goes up or down, right? If it goes up, I make my $713 on the premium, right? If it goes down, I will lose the same amount of money I would have lost anyway. And I'll still have your $713.
Yeah.
Okay. So if you want to close that option out early, okay, Now you have to buy it back at market price. But let's say it's Thursday afternoon and the NASDAQ is still at 540. What's the 610 call worth for the next day? Next to nothing, right? Mm-hmm. And what's the chances it's going to go up over 10% in a day? Very little. So maybe the day before you buy that back for $1, or you just wait for it to expire. If you want to hold on to the Qs forever, you just wait for it to expire and nothing happens. It becomes worth 0 at the close on the expiration date, assuming that it's below the strike price. So NASDAQ goes down to 550. You lost the exact same amount of money in your account. Your account balance went down the exact same amount it would have if you just bought the Qs here.
But still, it's an unrealized loss.
But you've got a $713 gain as well.
Yeah, right.
And let's touch on that.
You lost nothing because you didn't get rid of it.
Yeah, see, I've always had a problem with that mentality.
Yeah.
Okay. Let me ask you this: when gold goes up, whether it's in the ounces upstairs or the GLD or it's the Qs or Nvidia or whatever, when that goes up, what do we say? I made money.
I don't, but I'm sure people do. I don't.
Yeah. But if you go talk to a regular old financial planner, they'll be like, yeah, see, you made money this year. You're up, whatever. When they go down, they go, well, you haven't realized that. You can't have it both ways.
Yeah, I think of it both ways.
Yeah, and if you do,
until I take it out, it's nothing. It's just digits on a page.
Right. But my point is the traditional financial planning industry, when it goes up, they're like, see, you made 20%. When it goes down, they go, well, you haven't realized it. Well, I didn't realize the gain either.
Yeah, I had my conversation. Well, funny enough, we had our annual conversation with our broker last week, and that's what she led with. We made 22% last year. I'm like, did I? I don't feel it because I didn't take it out. So doesn't mean anything.
So, and good for you for seeing it both ways on that. But what did she say? You made 22%.
That's right.
If you were down 22%, she'd say, well, you didn't realize that.
Exactly. No, she would.
You can't have it.
You know why? Because she's managing my freaking money.
Exactly, sir. Yeah, she doesn't want you to pull your money out. So they gloss it up. Okay. So this is selling an out of the money strike price above the current price, and also I'll call it at the money for 610 covered call. It's a way to generate some revenue off of this. Here's the thing. If you go talk to your financial planner or any financial planner, they will poo-poo this to the moon, because most people will look at this and let's say during this week, the NASDAQ goes to 640 and you had to get rid of it at 610, 617, and 625. Most people will call them up and be irate that they lost money.
Sure.
Therefore, they will poo-poo these things all day long. Plus, they don't want to put the work in.
Yeah.
And I get it. They're running a business. Time is money, right? They don't want to put the work into this. And most people who trade in these don't understand the cost benefit analysis. Okay. I do this, what we laid out right here. I do this all the time. And I'm fortunate enough I can do it inside my 401k, and you can do this inside IRA. So all you have to do is get option qualified. Super easy to do. Okay. Just a few mouse clicks, and you can do this right inside your IRA. Just be aware that you may lose out on potential gain. But let's think about this from a retirement standpoint, because this has completely changed how I see my retirement planning. Let's say I need, hang on, math and public again, Illinois public school education.
Where'd you go to college? Embry-Riddle?
No, Southern Illinois University.
Oh, did you?
The Salukis. All right. So you brought in total, if you sold all three of these covered calls, you brought in $1,185. Let's call it $1,200. Okay. You brought in $1,200 that week off of this.
Yeah.
That's $4,800 a month, right?
Yeah.
Actually more than yeah. Sorry, math and public again. $4,800. You brought in $5,000 a month off of this. Guaranteed. No matter what happens to that stock price after that, you brought in that money. Well, that's a whole lot better than pulling money out of my account, right?
Amen.
And if you got enough money saved up to keep doing this, it limits your downside to this in the sense that if you can bring that back up.
Sure.
Okay. It doesn't, I shouldn't say it limits your downside. It cushions the blow. Let's say the NASDAQ goes down to 600, and I'm going to use round numbers here. Let's say we bought it at 610. Okay. If I have 300 shares and I lost $10 a share, right? I lost $3,000, but I cushioned that with $1,200 of premium.
Mm-hmm.
Okay. So either way though, I keep that 1,200 and I can turn around the following week and do this again and again and again and again. And if it gets called away, I just buy it back. Okay. Now you don't have to, if a person doesn't want to manage this monthly or weekly, rather, you could do it monthly.
Mm-hmm.
Okay. The main option expiration is the third Friday of every month. Used to be that was the only options, was the third Friday of every month. Now they've gone to weekly and even dailies. Okay. Because there's a gambling market out there for dailies. People will buy and sell every morning the options for the queues at the end of the day. Okay. That's gambling. Okay. But if you go a month out, you can get some decent premium and you don't have to do anything between now and, in this case, say February 20th is the next third Friday, the regular option closing. And the next one after that, I think, is March 20th, if memory serves. Yeah, mm-hmm. March 20th. Just happened to be the 20th 2 months in a row. Okay. You can go through and just churn that premium time after time after time. And that's the benefit of this.
Yeah. Self-licking ice cream cone for real.
Exactly. Right.
Yeah.
And in the end, let's say it went down to 600. Your account balance went down by the exact same amount it would have if you hadn't done any of this.
Mm-hmm.
So it's the best of both worlds. The loss, the unrealized loss on it is the exact same, but you get the premium. You do limit your upside though. But if a person has enough money saved up for retirement or whatever your goal is, when I'm 70, I'm not really worried about growing my account balance. I need income off of this account.
Yeah.
Right. So it can be used in the meantime as a way to do that. Make sense?
Yeah, not a bad idea.
All right.
Next week, if they start making synthetic call options so that I can just do whatever Will does.
Well, you can do that. So I'm going to throw a couple tickers out there at you, and so there's QYLD, Quebec Yankee Lima Delta, QYLD. That is a fund that does exactly this. And they go a month out. Okay. And I can perk your ears up right now. Pays a 12% dividend.
Jeez. All right.
Yeah.
Yep. And let's see.
QYLD
is $17 a share, $17.72.
Yep. And it pays out. I mean, it just sits there and cranks out a 1% premium every month. Now, the problem is I shouldn't say, my belief in watching them loosely is they don't manage the covered calls within the month. They sell them for the next month out. And if the queues go down 10%, you're going to get your 1%, but you're going to ride that down. Okay. So they don't manage it within that. There is another one out there. Full disclosure, I have money in both of these. They're BlackRock products. BD Max, and BDMCX. Bravo Delta Mike Charlie X-ray. Okay. Full disclosure, big fees, 5% up front. And if you don't hold it for 5 years, they hit you with a backside fee as well. But here's the beauty of it. It's a market neutral fund. So the market goes up 10%, it's going to go up maybe 0.25%. But it churns a 12% dividend. I'm sorry, 10%. They churn a 10% dividend. And BlackRock knows how to run money. You can love them, you can hate them. For all the other stuff they do, they can run some money.
Yeah.
And if I go over here to this and I throw, helps if I type correctly. I throw BD Max in my chart here. Bear with me, guys.
feel like Michael, or Steve Carroll's character. Yeah, it's a bubble. Yep. Short everything.
Yep. I mean, if you look at a chart of BD Max, let's see, it was $10 and $10.50 back in 2016. It's at 14 now. So it moves very little.
Mm-hmm.
Okay. But it sits here and just churns out a dividend that pays out twice a year.
Mm.
So it's a way to play it. Like I say, you're going to pay heavy fees up front, but they manage everything. And I actually replaced the bond portion of my portfolio with BD MCX, full disclosure, not financial advice.
Really? Wow.
Yep. Because it pays twice the dividend. So even if it goes down a little bit, I mean, a bond fund's paying 3 or 4, it's paying 10.
Mm-hmm.
Right? Let them run the money. You think BlackRock is going to know if the world's going to fall apart and do something with positioning? Yeah.
Mm-hmm.
Yeah. Yep. So, so back to the original point here, guys. This is a way to use a stock position you already have. Don't buy something simply to write a covered call on. I don't do that. Okay. Yeah. Now, I shouldn't say that. Sometimes I do that, but I also make sure that whatever it is something I would want to own. Okay. I don't do it on, I don't know, Palantir. Too volatile. You'll make a bunch of premium. You'll make a lot of premium, but I don't know enough about them. They're too volatile. It's not worth it. I'm not trying to make 90% annualized on these. Okay. Because let's figure this out real quick. I'm going to math again. So let's take your at the money one, your $7.13. Okay. Can you bring your calculator up on your computer there, brother? Do this along with me here. So
can I? Oh, I can do it on my
or on your phone, either one.
Yeah.
Okay. All right. So you're making in the case of your 610 strike price here, right? You're going to bring in $7.13 in premium. You're selling the covered call now. We're both going to sell it. Okay.
Okay.
So you're bringing in $7.13, correct? And you divide that by, let's just call it 610 a share. Okay. $610 a share. Okay. So you're making
divided by.
Yep. So you're making what? 1.16% for a week. Correct. And there's 52 weeks in a year. I call it 50 weeks because between Christmas and New Year's, so I call it 50 weeks. So multiply that by 50 weeks. What's that work out to an annualized rate of return?
Are you talking about 50%?
So you're talking, 58. You're talking about a 58% annualized return.
Yeah.
In technical financial terms, we say that does not suck.
No, it's pretty good.
Okay, so let's do another one here. Let's take our 625. So take $1.12 divided by 610 a share, right? So that works out to, go ahead.
No, go ahead.
So that works out to basically 0.2% in a week, right? And you go, come on, Will, big whoop, right? I'll multiply that by 50.
About 10%.
Yeah. 9.2% annualized. What are most people's financial plans built around? A stock market that goes up 8%.
Yeah.
You're beating that just by doing this.
True.
And you're still going to get from 610 to 625 if it goes up. So you're getting a guaranteed, because it is guaranteed, because you get the premium money right away. You're getting a guaranteed 9% annualized return on selling that 625 call. 58% on the at the money in this example, and somewhere in between for the other one. So I ladder these out like that and then walk away from the computer.
Yeah.
And I'll be doing that here in about 15, 20 minutes for the week. When we get done here, I'll fire up the old machine here and have at it.
It's time to make the donuts.
Exactly.
Yeah.
And that money goes into your account immediately. If it's a 401k, an IRA, that becomes part of your tax deferred account balance. If you do it if you're doing that in a brokerage account, in other words, not an IRA, not something that's tax deferred, that these will always be taxed at short-term capital gains, whatever your rate is. Okay. Right. But I will take 60% of something over 100% of nothing. That's just me.
Yeah.
Okay.
You're just weird like that.
I am. It's the math thing. Okay. So these it requires a little bit of work. Okay. But once a person gets into doing this, a quick glance, I mean, doing these 3 trades, I don't know, 2 minutes, 3 minutes. And it's just like trading a stock on your platform. You just to the right of where it says volume on my actual screen, where I took the screenshot at, it says trade. Boom. You put the order out there. Somebody buys it. That money hits your account balance immediately. Move on with life.
Nice.
So where, if it goes down, well, you were gonna hold it anyway, right? And that's why I say I only do this with stuff that I want to own anyway. You can do this on individual stocks, Nvidia, Google, take your pick. Going to be more volatile than an index. You're also going to make more money. Let's say one I like to do this with is Dollar Tree and Walmart. They're not very volatile, so you don't make as much premium, but those are 2 stocks I plan on holding forever.
Yeah.
So why not make a little premium off of them? And you don't have to do it with all of it either. Let's say a person has 600 shares of Walmart. Do it with 300 of the shares. Hold the other 300 just because you're going to hold them anyway. You do you. Maybe you do all 600 shares way out of the money, but you don't want to risk having those shares called away. So in this case, you do all 600 down at like our 625, something way out of the money. And with Walmart, you're probably only going to make like a nickel a share. And people will say, well, geez, Will, nickel a share, 100 shares, you're making $5. Well, hey, it's $5 I didn't have. Right. Okay. And so you do that with 300 shares, Walmart, you brought in $15. Well, hey, it's $15 I didn't have. Okay. Plus you do that week after week after week after week, year after year. It adds up. Right.
Oh, it most certainly does.
And if Walmart stock goes down 10%, well, okay, I was going to hold it anyway. So is it for everybody? No. Neither is owning fill in the blank.
Right.
So that's where, some people are like, oh my gosh, it's all this work. And I don't know. I mean, I enjoy it. So I'm not the person to ask about how much work it is. Okay. And it's like anything else. After you do it a bunch of times, it becomes almost intuitive. You just do this, bing, 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 done. You develop your patterns for this. Where this can hurt is if a person doesn't understand both sides of it. But even if the market's going down in general, just keep churning them out. NASDAQ goes down 20% in a big correction. Okay. I was going to hold it anyway.
Right.
So, yeah.
Kind of like me and my favorite pet rock.
Oh, yeah. When I had AI make that for you when I sit in a hotel room, I just laughed and chuckled.
I bet you did.
I'm like, oh, we're going to get him up to his target heart rate with this one. You didn't know, but I talked to Miss Lisa. I'm like, have those heart pills handy.
No cardio needed today, buddy.
Yep. What do we got on this one, brother?
Because you don't become successful by having big goals that sound impressive. You become successful by doing small, boring actions long enough to compound.
Yep.
100%.
And that's where I threw that one in because that's where I see these covered calls at. They're a piece. Let's say a person had 500 shares of the Qs in their portfolio. So maybe you only do it with 100 shares.
Right.
Maybe you do it with 100, maybe you do it with 300 shares in a ladder like we just showed, and you let the other 200 just ride. Right? There's 1,000 ways to skin that cat, but keep doing it over and over and over again. And you take those ones that are out of the money with a 9% guaranteed, because the money's already in your account the moment you sell it. I mean, I'll take a 9% guarantee. I'm in my late 50s. 9% guaranteed. Yeah, I'll jump all over that. Because I don't need to maximize returns at our ages. Thankfully. If you need to maximize, if a person needs to maximize their returns, this is not the way to go. My kids are in their, they're 19 and 24. They're not doing this.
Yeah.
Okay. Just because why bother? If suddenly something gets announced and I've got them in Walmart, as a matter of fact, and Walmart goes up 10, 12% a week because they announce something like they're bringing out their own buy now, pay later. I don't want them to miss out on that.
All right.
I'm willing to miss out on a little bit of that for the guarantee with some, because I don't do it with all my Walmart shares. So it's that back and forth. Think of it like like our gold discussion, right? You're strictly the insurance side. I'm doing both. It's kind of the same thing here. I can have my Walmart that I'm never going to sell no matter what, and I'll have some I'll do this with.
No, I can see that at the end of this discussion. I think I definitely see that where I don't think I did before. Still seems like gambling to me, but at the same time, I don't see much of a downside if you do it the way you're saying.
And that is the danger. And in fairness, that is the only way to do this. There literally is no other way. If you own the stock and you sell the call, this is how it works. There's no, you better make sure you click on this box. There's nothing else, literally. And where you are now is where I was when I first ran across a YouTube video talking about this. I'm like, there's got to be a catch somewhere. There's no catch.
And you've been doing it how long now?
Started paper trading it about 1.5 years ago. Been live trading it for about a year. And, it's, in that case where the Qs are at 610, if something happens and they go to 580, I got the premium.
Right.
And I was going to ride that loss either way if I was going to hold it. Right. So the only downside is missed opportunity to make more if it goes above that strike price. But again, if you ladder it and maybe keep some clean, if you will, you don't sell covered calls on some of it, you still participate.
Yeah.
And part of this is age and circumstance. Guys like me and you, we don't need all the upside. Right? I'll take the guarantee. Thank you very much. So it's not for everybody. But there's really the risk is loss of potential gain. You cannot lose money by doing this. You can lose money, but only if the shares go down, right? But the call part of this, the covered call part of this, will never lose you money. You get that money no matter what. What you're doing is with your side, though, if you can come back up on the screen.
Yeah.
To your point, let's say you have that 100 shares of Qs and you're selling that covered call. You're selling to the gambler. You're not the gambler. You're the dealer.
True.
Right? The gambler at the blackjack table can make a whole bunch of money, right? But, the casino builds those big buildings because consistently they make money.
That's right.
Yeah. So you're selling to the gambler. And sometimes the gambler wins and you lose some potential gain. But that's the worst case scenario. Yeah, exactly. Yeah. So, yeah. So that's it.
Well, thanks again, my friend. Always a pleasure to talk to you. Next Monday, I will be teaching with Mr. Seeklander down in Florida.
Okay.
So I will not be here for a week.
All right. Sounds good.
So,
the next time we talk covered calls, guys, we're going to probably only talk about that. We won't do any new stuff unless there's something really drastic in the financial world. Because now we're going to sell, in this case, we did the Qs that we bought at 610, right? And we sold those covered calls above the purchase price. The strike price was above the purchase price. Now we're going to go in the money. So you bought it at 610, you're going to sell the 600. You're going to sell the strike price below. Why would you do that? Because now you can get the best of both worlds. You can make money and have downside protection. It's not a guarantee you won't lose money, but it goes to your insurance stuff. And those are the ones I use a lot of. Okay. And you can make some good premium off those and have downside protection. So if you bought it at 610 and it went to 600 and you can still make money, does that sound interesting?
Very.
That's exactly what we're going to talk about.
And until then,
the fight is coming. Be ready.